Everyone thought this was a done deal. $7 billion. That was the number whispered in private boardrooms. The fastest growing startup in Indian quick commerce. Two dropout founders who built a delivery empire in 3 years. An IPO filing already submitted. Then the public market spoke. $2.5 billion. Same company. Different reality. The gap between what venture capitalists believed and what pension funds would pay just killed one of India's most hyped public debuts. Is this the end of growth stories in India? Is quick commerce a real business or just subsidized convenience? Or did everyone miss what was hiding inside the financials the whole time? Before we go further, subscribe to this channel. Most people think Zepto started as just another delivery app. 3 facts say otherwise. First, the founders were 19 years old when they launched, making them the youngest unicorn founders in Indian history. Second, they did not invent 10-minute delivery by accident. They studied GoPuff in America, realized Indian cities were denser, and bet they could go faster. Third, Zepto hit unicorn status in under 2 years, the fastest path to $1 billion for any Indian consumer startup ever recorded. The underdog moment came in 2022. Funding was drying up everywhere. Competitors like Dunzo were collapsing. Zepto raised money when nobody else could and opened 300 dark stores in 6 months while rivals shut down. By March 2026, the company was doing 22,623 crore rupees in revenue. Double the previous year, that was the peak. This is where the real story starts. Zepto filed its draft prospectus with regulators in December 2025. Standard process, confidential route, investment banks lined up. Goldman Sachs, Morgan Stanley, Axis Capital. The roadshow began. This is when institutional investors, the pension funds and insurance companies who anchor every large IPO, get their first look at the real numbers. And they didn't like what they saw. The company's private investors, the venture funds, who had poured in over $1.35 billion, had valued Zepto at $7 billion just months earlier. But public market investors, the ones who actually had to write checks for the IPO, came back with a number. $2.5 to $3 billion, a 60% markdown. Not a negotiation, a rejection. The venture story that had carried Zepto this far hit a wall, called reality. Why? The lost number. 5,905 crore rupees lost in fiscal year 2026. That is almost $700 million burned in 12 months for a company that had never posted a single quarter of profit. Public markets do not buy growth anymore. They buy a path to profit. Zepto did not have one on paper, so the IPO was shelved. But here is what nobody asked. If the business model was broken, why were the numbers improving? Look at adjusted EBITDA loss per order. That is the amount Zepto loses after accounting for overhead on every single delivery. Fiscal year 2025, 136 rupees per order. Fourth quarter fiscal year 2026, 59.4 rupees per order. Cut in half in 18 months, orders per dark store per day went from 1,425 to 2,140. A 50% jump in store productivity in 1 year. Total cost per order dropped from 181 rupees to 128 rupees as volume scaled. These are not the metrics of a dying business. These are the metrics of a business that is slowly fixing itself. But they were not enough. The absolute loss was still widening because Zepto was opening more stores. Revenue doubled, but so did the cash burn. Public investors saw the direction, but not the destination. They wanted a timeline. Zepto could not give them one. The gap was not about the business, it was about when it would stop losing money. And nobody knew the answer. Then the other number showed up. April 8th, 2026, 2 months before Zepto filed its updated draft prospectus. The Enforcement Directorate, India's financial crimes agency, issued summons to both founders under the Foreign Exchange Management Act. Not a criminal case, a compliance review. The agency wanted documents, foreign investment records, shareholding patterns from fiscal year 2021 onward, bank statements, tax returns, a note explaining their business model. Both founders appeared, submitted everything. As of June 2026, no findings, no charges, no follow-up communication. Zepto disclosed this in its public filing anyway. Most companies bury these details. Zepto put it in black and white. Why does this matter? Because it points to the single biggest risk in taking any Indian startup public: regulatory scrutiny of how foreign money came in and where it moved. Zepto had done a reverse flip. It started as a Singapore company and moved domicile back to India in January 2025. That process is legal but complex. Every foreign investment flow has to be untangled and redomiciled under Indian law. The Enforcement Directorate reviews this for every reverse flip. Razorpay went through it. Grau went through it. It is part of the process. But it is not a good look 2 months before your IPO roadshow. And it raises a question public investors always ask but rarely say out loud. If the government is reviewing your money flows, what else is in there? Now add the competition layer. Blinkit, Swiggy, Instamart, Big Basket, everyone is in this war. Blinkit has nearly 50% market share and reported EBITDA positive stores in some quarters. It is backed by Zomato, a profitable publicly listed company. Swiggy Instamart has the full balance sheet of Swiggy behind it. Zepto is standalone, a pure-play quick commerce company with no other revenue streams. When the market turns and everyone has to cut discounts or raise prices to stop bleeding, Blinkit and Instamart can subsidize losses with their parent companies. Zepto cannot. It has to stand alone. Public investors saw this and adjusted their math. A pure-play quick commerce company in a three-way war with better funded rivals. The risk premium on that is massive, so they cut the valuation in half. The competition risk was not new, but framed through the lens of public market durability, it looked different. Venture investors bet on speed and market share. Public investors bet on who's still standing when the subsidies stop. Zepto had not proven that yet. Here is the framework. The gap between private and public valuations is not random. It maps to two different investing philosophies. Private investors buy optionality. They invest in 10 companies knowing 9 will fail and 1 will return the entire fund. So they overpay for potential. They do not need profits today. They need the chance of a monopoly tomorrow. Public investors buy cash flow. They need to see revenue turn into profit within a timeline they can model. They are not gambling. They are pricing an asset. Think of it this way. A private investor looks at Zepto losing 60 rupees per order and says that becomes positive in 2 years and then we dominate. A public investor looks at the same number and says prove it. Show me the unit economics at scale across every geography with no more funding. Zepto could not. The model works in theory. Dense cities, high order volume per store, automation in warehousing, lower per order costs. But theory and execution are different. Until Zepto shows EBITDA break-even at the company level, not just at mature stores, the public market will not pay a growth multiple. That is not pessimism. That is how public markets work. And it is why Zepto is now raising a smaller pre-IPO round at $4.5 billion instead of going public. They need more time to prove the model, from $7 billion to $2.5 billion to a paused IPO to a down round. That is the journey in 1 year. Zepto is not dead. It is still growing. It still has millions of users. The service still works. But the story changed. For 3 years, Zepto sold speed. Now, it has to sell sustainability. The verdict: Zepto will either prove quick commerce can be profitable at scale and list at a premium in 2027, or it will stay private, merge with a larger player, or accept that this model only works as part of a bigger ecosystem. The law: you can raise infinite money in private markets on a growth story, but you can only go public once. And that one chance depends on proving you are a business, not a bet. Remember the number we opened with, 7 billion to 2.5. That gap is the distance between belief and proof. If you know someone still convinced unicorn valuations mean anything, send them this breakdown.